Holy moly guacamole. Ladies and gentlemen, it's not over. And by it, I mean volatility. I got some interesting charts to show you today on the Stock Market Brief Show. If you're new here, welcome to the channel. Consider subscribing if you like this type of content. And if you haven't done so already, smash that thumbs up. It's greatly appreciated. God, I'm horrible at drawing thumbs, I tell you what. Today's date is January 18th, 2022. We got some interesting charts to go over. Let's get in to today's episode. Alrighty, everybody, welcome back. We're going to start off looking at the 11 sectors that make up the S&P 500. Energy was the only one in the green. Go figure. We're going to talk about that. Real estate crept its little nose up there in the number 2 spot. That's matching the seasonality, which we discussed in a prior brief. If you take a look over here at the indices, whoa, small caps got obliterated. NASDAQ got obliterated. NASDAQ 100 got obliterated too as well. Crazy stuff. So let's really quickly talk about, because we had bank earnings, right? So financials. I want to dive into financials really quick. Boom, 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 shaka boom. Where's my pen? Here we go. XLF. That's what we're going to talk about. It was down 2.23% today. All right, that's interesting because I've been talking about this, obviously this monster rise up in financials, also energy. And I just wanted to show you just how, these type of moves, they do get pullbacks and they consolidate. They don't just keep going straight up. And this is just how dramatic it could potentially be. So for example, like we came up all the way up here. It was a second spot year to date. I have to check now what it is, but came up to 41.75. And in literally 1-2 trading days, it wiped out darn near all of the gains for the year to basically end up flat. In 2 trading days, and it's January 18th. So as the rates have been increasing, which we'll go over those charts, perhaps banks kind of priced in the move already, right? Rates have been going up and banks have priced that in, and now we're starting to see a sell-off. It's anybody's bet at this particular point in time. It's very volatile, and I'll keep continuing to talk through all my thoughts and kind of what I'm seeing out there in the marketplace, which you'll see what the options market is pricing in again. It's crazy. Let's look at Goldman Sachs. They reported earnings. This right here is dangerous, right? Very, very dangerous move here. So first off, huge gap down 6.97% on the day on the reported earnings. But it wasn't really even falling apart here. It fell apart here on that big gap down. And you can see why this is dangerous. Let me just kind of give my thoughts here. First and foremost, all this up here, which is about 6 months of trading, which is a lot of volume, that's now all trapped supply. And what's scary about it is it gapped down and came down here, a big, huge volume day. So that right there, you gotta think, like, even if this bounces up to here, there's going to be institutions, there's going to be hedge funds, there's going to be a lot of traders up in this area that are going to take advantage of a bounce and potentially sell into it. So if you're buying on these dips and they're starting to rip, just be very mindful. It's not impossible for it to come back in this channel. But a break like this on that type of volume, you just need to be very, very careful in this environment as it cracked through this 200-day very aggressively right there. Now, pretty much right across the board, as you probably witnessed today, all big mega cap stocks completely obliterated. But this is like a full-blown correlated market to the downside. And you can see that here looking at the S&P 500 advancing and declining issues. You had 57 advancing stocks, which were basically far and few between. Some energy names, right? A couple other, like one utility name and Visa, I think, and Verizon and Activision, a couple random names. But then you had 446 declining stocks. Clearly, lots of capital flowing out, especially compared to the advancing stocks. All right. Now, if you look year to date, just look at the start to this year. If you are struggling year to date to bring in profits, that kind of makes sense. Unless if you've just been long energy and long, I guess financials up until recently, you're doing decent. Other than scalping here and there, that's totally fine. But if you're holding these mega cap stocks, all the indices are down year to date. IWM, Dow Jones, so Russell 2000, Dow Jones, S&P 500, the NASDAQ 100, the NASDAQ composites in correction territory. All right, it's a very difficult environment to navigate, especially if you're using leverage or option trades and you're not protecting yourself. Yeah, it's going to be a very difficult environment, obviously, from the long perspective, I should say. Okay? All we have control over is risk. That's really all we can control. So we need to make sure that we're paying very close attention to our entries and being very precise on entries and making sure that they're low risk entries, that it makes a good risk to reward entry. I talk about it so frequently on this show, and these are the reasons why. All right, now if we just take a look at the relative strength of the Fangman stocks, all completely getting obliterated from a relative standpoint, other than Apple. So if you're looking for strength in a particular stock for buying bounces, I mean, Apple right now, like you can try to bottom fish some of these big ones and you can get lucky, but Apple from a relative standpoint is the one that stands out the most. So Apple should be watched very closely. You can see there was a little bit of a flight to safety in the dollar, pow in the dollar. What's that do? Well, S&P 500 came down. Various commodities kind of fell too, except for oil, and oil has been on this monster tear, helping out the energy stocks. That is one very tight rising wedge right into an area of resistance, and it fraught the RSI. We've seen what happened to financials. Don't rule that out over here. It's going to be a period where we're going to get a consolidation or a pullback. I don't know when that is, but you can say that when we crack a high and then we come back in, that right there would be a bull trap. So you got to be mindful of something like that. And if it comes back in, yeah, be very careful. And then also, we got to start being prepared for where it pulls back too, because, if we get a 50% retracement of this move, boom to boom, somewhere around there, I would definitely be looking at energy stocks for a potential play. If you look at the XLE put in a hanging man type candle, not the greatest looking candle. You can see it, what a wild day. It gapped way up, ran up, sold off a couple percentage, and then rallied back. It was a wild trading day. So it is showing that there are sellers here, but there's still buyers pressing it back up. Hanging man candles can be topping type candles. So look for a break and close below the low of this candle, which was 63.78, for potential further downside or for the move to kind of stall out. Now, I showed you a previous chart of the relative strength line of energy and the S&P 500, and it lined up almost perfectly to the 10-year yield. So when the 10-year yield rise, energy outperforms the S&P 500. And you can see here, the 10-year yield is putting pressure on everything. Tech did not like that move. Many stocks did not like a 5.25% jump coming in at 1.86 for the 10-year yield. It's a monster move, and it's putting a lot of pressure on the markets. And you can see that the TLT broke down from this trading range. I was stopped out on this day for a break-even trade. And this is why you have to monitor risk. And this is why you have to try to free roll trades and get your stop to break even or take profits when you can, is because you just got to gap down and then it rallied to the downside. I will say this, though, because we were looking at, on the previous video, looking at volatility ranges, and the TLT came right down to the lower range that it priced in for the week. Now, it could head lower. It's basically saying 70% of the time, a little bit less, it's gonna end up closing within this range. So it could come out and come right back in. We'll see. But you can notice that it's coming into, obviously, a prior area of resistance, and resistance can become support. So this could present itself an opportunity for a potential scalp, especially if you manage to get out unscathed right over here. So it's something to keep an eye on, but just like this environment is, you don't want to press your limits in this environment, because if you're on the wrong side of a trade in this environment, it can get pretty crazy. As you can see here, the spreads flattening out. So this is the 35, the 10 and 2 remained, it didn't really go anywhere. But you got to also wonder, with the 30 and 5 continuing to flatten out, and it's 0.53 right now. The lower it goes, the closer to inversion. And what is the Fed going to lift rates in March while a yield curve isn't flattening or potentially inverting? It's going to be 2022 is going to be a difficult environment to navigate, especially if that is the case. Now, let's continue on to the SPY. SPY tagged the lower range just about almost perfectly. The SPX, S&P 500 did tag it perfectly. And you can see we found it as it kind of acted like a little bit of support. I don't use these levels as support, resistance, or support, but it's lately been acting like that. And one thing that we mentioned on the previous brief is it's like the very first trading day, the move is hit. And this was it's a shortened trading week, and it was pricing in over an $8 move. This is where it gets pretty crazy. And it hit it day one. But this is where it gets even crazier. So now that we had one day out of the way and we hit the lower range of this expected move, I went into the options chain just to get a good idea as, okay, well, did volatility subside at all? Answer, no. The range between now and the end of the week is the same as it was on the close of business Friday. So volatility is still here. Expect some wild trading Wednesday, Thursday, and Friday. As you can see, the blue line was what it priced in the previous week, and now it's pricing in the same move. And that means it could come down to 447 to 450, this range, by the end of the week. Now, it is said that, 68%, 7% of the time, it could end up right back in here. And I don't want to rule out that we can't get some kind of monster bounce, right? So volatility goes both ways. It goes for you and against you. So volatility, we can see a very quick pop right back up. That's absolutely possible, especially looking at a lot of these stocks that have just been completely and utterly destroyed. Now, I want to, hopefully you're listening to this, but I want to be very, very cautious here. I'm going to be very cautious here, and I want you all to be very cautious. Is today's move was very aggressive. And by very aggressive, I mean it was a very highly correlated move to the downside, meaning many stocks were down on high volume. And that right there is a very dangerous recipe. Now, that doesn't mean we can't bounce. But if we bounce, pay attention to volume, because if we start bouncing on low volume and we're coming from a place of coming down with many stocks on high volume, it's going to be a very, very wild environment. Investors Business Daily, they already updated their projections from uptrend under pressure to market correction. So it's time to be very careful. If you take a look at the SPY on the 30-minute time frame, you can see here we tagged that lower range. I was ready. I played intraday from right here, posted that on the Discord and caught a little bit of a bounce, and then I just got out right there. So it was a very small game, but I used a leverage play to trade it. Nothing crazy. But you can see here, we're right there sitting at the lower range, still below that 5-day moving average. Can we bounce from here? Yeah, cool. I mean, we have now a gap that needs to be filled right over here, this blue box. So if we start bouncing up, start looking at this potential for an area to short again as it comes into a declining 5-day moving average, and a gap fill can act as resistance, just like this gap fill can act as a level of support. All right, now if you take a look at the VIX, we're looking at the 30-minute time frame on the VIX. Pretty strong move in percentage-based terms, up 18.76%. Rising wedge type pattern. We now have a gap below us, and it's bringing in a high right here on a negative divergence. So that, if we are going to get a bounce, I would expect this gap here to get filled and potentially even come back to this 18.5 to 19 range. Now, the risk remains still to fill these two gaps up here, and there's even one higher up at 45 to be very mindful of. Okay. Let's continue on now. I want to look at the indices, the Qs. I want to look at the Qs, sorry. We're looking at the indices already. One thing to call out is we did break down through this uprising channel. It's shorter term. Don't put too much weight on it, right? We're still right next to a rising 200-day moving average. It's very possible to come and touch this as the options market is still pricing in a lot of volatility. You can see these blue lines right here. Day one of this trading week, tagged the lower range already. So that, that's just what it's been like, right? So a single day, I mean, coming into the week, it tags it right out of the gates. Now, I've showed you previously on like a JPM chart. That was during the financial earnings, and I showed the risk range. And what I demonstrated there when I showed the recap on the previous video is when it gets way outside of a range, be very careful. Especially if it gets way outside of that weekly range, because if it gets outside of this weekly range, new hedging has to take place, all right, which could result in more pressure to the downside. Things can get more wild when it's not in its little safety zone, all right? And we're basically right there, so nothing's too crazy right now at this particular point in time. Now, if you take a look at the 30-minute time frame, you can see here, came down, just hit right into this blue line. That was the trading range, and is right here with this previous area of support where we bounced up. Now we're right here. A lot of the tech stocks, like I already pointed out, they've been getting clobbered. So is it possible to see a bounce? Yes, but don't chase, don't be too aggressive, because if we do get the bounce, just be mindful. It could be a day like this. It's going to be a lot of whipsaws and a lot of craziness. And, if you're not adjusting to that market environment, like, you're going to just get whipped around. So be very careful, right? You could look at this as a potential falling wedge here. RSI, positive divergence, could bounce up. But if we get we could get a gap up tomorrow just to fill this gap, and then start looking at this 5-day moving average as a potential area of resistance. Okay, let's continue on and look at some of these indicators, and then we'll hop into the IWM and then close it off. So the percent of stocks above the 50-day and the 200-day moving average are declining as price is declining. We've been talking about the termites eating away. Well, this is contributing to that. More stocks are falling below these key moving averages. You can see below the 200-day on the NASDAQ 100, 50% of it, so half the stocks in the NASDAQ 100 are below the 50-day moving average, and 50% are above it, right? So not exactly the greatest thing to see. And when we hit these low levels, you typically get bounces. But like I said, we broke through this today on some very significant volume. So even a bounce, you need to be very cautious on those. Another thing to pay attention to here is the new lows. They've been building up for a while, and we've been paying attention to it. And you can just see here, as there more and more new lows hit, you can see just wild distribution has been taking place as we're breaking down even further here on the NASDAQ 100. And the NASDAQ 100, from peak to this trough right here, we're down like 9.6 or 9.8%. So we are just about in correction territory for the NASDAQ 100. Take a look at the IWM. We had a positive close the previous trading day. But as we stated, the volatility, it go for you and it could go against you. And day one, it tagged the lower range and actually closed slightly below it. And it did so on some significant volume. We also talked about the OBV giving us, on balance volume, giving us a little bit of a heads up. And we had a trend day down. Are we going to bounce? I can't tell you if we're going to bounce. What I don't like about this is a break this big on this big of volume. All right, so the move down, we're seeing on increasing volume, and yet the move up, it's been on declining volume. That's not positive. All right, so we get this, we've been in this trading range for a year or over a year, right? We had this little blow off top right here. At least that's what it is in hindsight, or a bull trap. And then we came right back in. We tried bouncing back in this range, and now we're at the very lower edge here. This is not particularly the point where I would just be like, yeah, buy that dip. Because even if we got a bounce, I wouldn't even care, because it's just very dangerous. If I were to buy this dip, which I haven't, maybe tomorrow I'll play it intraday if we do start bouncing, right? But the reason why I wouldn't play like a full-size position right here just to see about getting lucky is because sometimes during these high volume breaks, they can get follow-throughs with gap downs and another trend day. We've seen it a lot. Not as of recently, but we've seen it in the markets happen frequently. Now, if you look at the 15-minute time frame, you can see here, closed down beneath the lower range. Like I said, it can come right back in within this range. The market is still pricing in a lot of volatility. We do have a positive divergence on both the RSI and the PPO. So to see a bounce, it's not like, it wouldn't be wild to see a bounce coming back in. But just keep in mind, declining 5-day moving average, it's been acting as resistance as soon as it broke over here around the 5th. Okay, so if it comes back up, look at that as a potential area to pull profits on a long position, or, reduce position from a long position, or if you like shorting the markets, if you're familiar with how to do that and how you have to be aggressive, then that might be an area to watch for too. Let's look at the health dashboard. NASDAQ Composite is in correction territory, down a little bit more than 10.5%. PPO still heading down. You can see RSI has been dying off. PPO has been dying off. New lows have been building, which we previously discussed. New highs have been declining. The NAMO still well below zero, getting a little overextended. Composite over the S&P 500 from a relative standpoint, still pointing straight down. NASDAQ advanced decline line continues to head down too as well. Not a healthy market as it stands right now, at least not a healthy start to 2022. Okay, if we do take a look at the advanced decline line in this way, it's pretty overextended to the downside. You can see when we hit these little areas, we do sometimes get little bounces. Right here, we saw that was this move, and then we saw a little tiny bounce, but then it actually ended up heading lower. Right here, bounce. Right here, bounce. Right here was right about here, and then we saw a bounce too. So you could definitely get a bounce from this area as things are very overextended. You just need to be very careful. If we take a look at the summation index, it's starting to curl itself back over, but you can see the parabolic, the SAR over here, hasn't converted to bearish where you'd have to see a little dot flick above it. And if it does, then I would imagine this would start sinking back down. If this gets below zero, at the same time this gets below a minus 350 reading, there's been some crazy times when they both hit those levels around the same time. We've seen some pretty significant sell-offs. You can see that right here when it crossed down through zero. During that, we hit that 350 range right here, And then where else was it? Right about, was it here? Yeah, right here. Or minus 300, my bad. So right here, crossed down through zero, got that minus 300 reading. And then right here, we also got that minus 300 reading where we saw, actually, it didn't quite, it continued a little bit of a sell-off, but then bounced and then came back down a little bit there too. So be on high alert if that's the case. All right, everybody, that's all I have for you on today's episode. Just to quickly recap, you need to be very careful in this environment. Typically what you get on big red days like this, we've been getting bounces and then celebrations and we're smiling, okay? However, today today was interesting because we had a high correlated stock market to the downside and we had significant volume on a lot of these stocks that moved down. Okay, which is a recipe for further downside or potentially retesting some of these lower lows. An important level to watch on the S&P 500, the SPY. Let me bring that chart right back up. If the market wants to continue pressing lower, that 447 to 450 range right here where there's previous resistance and then this support, that could be pretty treacherous if we start getting down there. Overall, the market is still above a rising 200-day moving average. We're just starting to see more volatility, and when we get this volatility, it makes it significantly more difficult to play breakout trades, to play swing trades, etc., etc. So once again, this market environment, as it stands, it is not it's not an easy environment to trade. So do not up your position size if you are doing bad. If you are not getting winning trades in this environment, then your current strategy doesn't work with this environment. Let the market tell you that. And as soon as you start getting some positive trades on smaller positions, the market is then telling you, hey, your strategy, it's working in this environment. Then you can start to scale up and start benefiting and compounding your winning trades versus compounding losing trades. All right? It's the long game. You need to think very smart and tactically about this and strategically. That's all I got for you on today's episode. Everybody have a wonderful night.